Hey everyone, it is Wednesday, and you know what that means? That means we bring back our expert, Matt, the mortgage guy. How you doing, buddy?
I'm doing great, Mike. How you doing?
I'm doing well. So one of the things we're going to do today together is do one long video. We're going to bring up 10 to 12 terms that really have relevance in your business that sometimes, I don't know, raise questions. Maybe the individual investor doesn't know, home buyer doesn't know. They hear them, but they don't really know how it applies. Does that sound like a good plan?
Yeah, for sure. Because like me and you talked about a lot of these terms, very common questions for me,
Yeah.
conversations with investors and buyers.
All right, cool. So let's knock them out. The one that I get most often is points. What is points? Should you pay points? What are 0 points? What are 2 points? What's a point? When does it happen? Do I pay them? Do I not? What's that all about?
Sure. I feel like I should be good at this one because it's common. And when I was thinking of a list of mortgage terms, it was at the top because
Yep.
points is the most common question people hear. Oh, do I pay points? Do I not? And they don't even know what a point is. So let's define a point.
Okay.
If you have a $300,000 loan, 1 point equals 1%. So a 1 point on a $300,000 loan is $3,000. So if you hear half a point, it's $1,500. If you hear 2 points, $6,000. A point equals 1% of the loan amount. So now that we've got that out of the way, when would I pay points? Why should I pay points? Something to help people clarify that I explained to folks is you come to me, you've got a 760 credit score, you've got a 70% loan to value, and we'll talk about that term later probably. And you're doing a rate and term refinance. So it's not like I plug that into a system and that system spits out 2.625. That's the only option we have. You've got a rate sheet that starts at 1.99% and might go to 4%. And on this rate sheet, if 2.625, just for example purposes, is 0 points, 0 cost being paid for that rate, as you go down 2.5, 2.375, 2.25, it might be a half a point and then a point and then a point and a half. So paying points is spending money up front to get a lower interest rate. And sometimes it makes sense. Sometimes it makes little to zero sense. And the warning I think that people should hear is don't fall in love with an interest rate because it's used a lot in marketing. And if it costs 0 points for 2.625, but then a fancy piece of mail that comes in the mail comes and says, we've got a 30-year fixed at 2.25, jump up and down, you do a couple spins, special offer just for me, I can't wait. You get 2 weeks into this loan process, and then you look in box A of your loan estimate, you're like, wait, 2.25 points. What does that mean? Oh, $6,750. And you can talk to a loan professional that's going to give you honest advice and say, you're paying $6,700 for that 2.25. If it only saves you $43 a month, it's going to take you 13 years to break even. Yeah. And not only that, the $43 a month you're saving, 43 bucks isn't worth what 43 bucks is today in 2034. I can promise you that. Exactly. Like, especially with the money printers, the machine gun money printers we got going on right now.
Yeah, exactly. So again, when I hear points, obviously it's really around owner occupants and all of that, but we might as well hit hard money, right? Hard money investors, right? If you're a fix and flipper today, you're buying an asset that can't go traditional bank financing, you're likely going to pay points as well, but they're going to be 3 and 4 points. And what they're going to do in that situation is, let's just say you're looking to apply it for $100,000 in a hard money loan. They're not going to ask you for the $4,000. They're going to take it right off the loan, right? They're going to write the loan for 100 grand, but they're going to only give you 96 in a simple world.
Right.
So again, points are how lenders make money. That's really what I want you to take from this. And then again, as a homeowner, you should do a break-even analysis. Everybody has their own rules of thumb. What I tell people is, hey, if you're going to live in if this is your forever home, and you can get the payback, again, a point's $3 grand and you save enough where your payback somewhere between 3 and 5 years, might be worth it. If it's 15 years, it's a joke.
Right. And just for some quick clarification too, when you come to a mortgage broker like me, whether you pay 0 points, 1 point, 2 points, it doesn't matter to me because I'm brokering the loan and I'm getting paid off what the loan amount is.
Right.
And so, my only job as a broker is to find people the deal that makes the most sense. And a lot of times that's the conversation. How long do you plan on staying? No way on God's green earth would I recommend you pay points that have a 13-year break even.
Yeah.
But maybe as an investor, we look at the rate sheet, and to be quite honest, a lot of rate sheets for investor loans have the best execution at maybe a half a point to a point cost, because 0 points might be 3.875. And if 1 point's 3.125, then we're talking $100,
Right.
and it's a $2,900 cost. Well, in that case, yeah, this is a long-term hold. For sure you're keeping it longer than 3 years. Let's pay the point for 3.125. And so it's really something that you just have to be cognizant of and have somebody who has your best interest in mind talking you through it, because the fact of the matter is, when you've got these big, huge companies that are marketing low interest rates, they know it makes people excited. And so they're going to advertise the low interest rate. They're going to plug in a couple points with no regard for, does this make sense for your specific scenario?
Yeah. Well, you've brought up a bunch of terms I've already noted down. We're going to go to next. Let's talk about that rate sheet first. Because again, I don't think the average investor, and certainly not the average homeowner, really realizes it must be every day. And I'm sure some volatile days it's twice a day. You get a rate sheet from your different, institutions. And again, it is a sheet, right? You get a criteria, right? If the borrower is these things, they can have, these 5, 6, 7 different options. And it is your knowledge, your experience to look at that rate sheet and have those discussions and be in the daily trenches watching all of this that makes this valuable, right?
Right. Yeah. And that's if you can picture in your head all the rates at every eighth, 2.125, 2.225, 2.37525, and they all have a cost associated with them. Or as you get to a higher rate, they've got a credit associated with them. And that's going to change a couple times a day. So if you talk to somebody and says 2.625 is 0 points today, it might be a quarter point cost tomorrow. It might have a quarter point of rebate to you. And nobody really knows what's going to happen. And so, yeah, that's one thing. God, I had something else I was thinking about as you were saying that.
Well, why you think about that? The other thing I want to highlight again is you're here helping this channel grow. I want to make sure people realize, if you're in California, you're looking to buy a home, buy an investment, or do a refi, do me a favor, reach out to Matt, the mortgage guy. He has given his time every week to this channel. So Matt, how do you want people to reach out to you?
By email is cool. Matt, MATT at mattthemortgageguy.com. And even if you're outside of California, let's plug the YouTube channel. If you find Matt the Mortgage Guy on YouTube, go ahead and plug into that. I've been trying to put out, I was doing investing and mortgage and real estate and a bunch of stuff. I've been doing really mortgage heavy content. And I think there's plenty of stuff like the stuff we're talking about today, where people just need to know, should know. There's bad information out there. So honest, straightforward mortgage advice is mostly what you'll find on my channel. So come on over and subscribe when you get a chance.
There you go. Cool. The next thing I want to talk about, again, mentioned in the opening, we talked about points, is LTV, or loan to value. Why don't you talk about that?
Sure. So loan to value is your home's value versus your loan. And so for a simple example, if you've got a $400,000 house and a $300,000 loan, that $300,000 loan is 75% of the value. So loan to value is 75%. And that factors into what rate you get. Because if you are doing a refinance and you've got, you only owe 200 on that $400,000 loan, that 50% loan to value is less risk for the lender. So you're going to get a better deal. If you're borrowing 320 and you're 80%, you're higher risk to the lender of default. And so they're going to charge you a slightly higher rate. So that's what that loan to value term means. And for whatever reason, Mike, something that comes up quite a bit is people don't understand when they're looking at that and they go, okay, I owe 300, my house is worth 400. And if you tell somebody, most lenders won't let you do a cash out refi above 80% loan to value. So 320 is your max loan amount on a house worth 400. For whatever reason, I get people that say, I owe 300, it's worth 4. That's 100,000 in equity. I can borrow 80% of that. So I can take 80,000 out. You can't borrow 80% of the equity you have in your house. You can borrow up to 80% of what the house is worth as a loan amount.
Mm-hmm.
So that's something that I've had that conversation dozens of times. So take what your house is worth, multiply that by 80%, and that is what 80% loan to value is.
Yeah. There's two things I want to talk about with this term LTV or loan to value in the market that we're in today. One from an investor standpoint, one from an owner occupant standpoint. I want to stress it's loan to value, not loan to price, if that makes sense. In the world that we just left 2020, I can't tell you how many owner occupants are adding escalation clauses and removing appraisal conditions. So for example, just for simple math, let's use your example of a home worth 400. And who says worth? It's the appraiser, right? Let's just say that. And let's say that you're going to get a 25% or a 75% LTV or 80% to use your example. So you get 320. But because you've waived the appraisal condition, because you had the escalation clauses, you agree to pay 500. Willing buyer, willing seller. It's a market is made. Some people think that they can go borrow 80% of price. Wrong. You are borrowing 80% of value. So in this example, you will be on the hook for $180,000 at the closing, right? I need you to hear that, because again, in a hot market with no inventory, adding escalation clauses mean if you're an owner, you're going to bring a lot more money to the table. So I just wanted to make that point.
Right. Yeah. That one's a pretty extreme case.
Yes.
But the point is that, yeah, it's loan to value, not loan to what you're willing to pay.
Yeah. I just want to make, and again, I like using extremes because people like to argue at the margins. So I just put out a 100K example and then hopefully nobody argues. The second thing is for investors. And really it was last year, maybe late 2019, BRRRR was really, really hot, but the market was evolving. I think BRRRR is going to come back into focus, but let's have this conversation about BRRRR. So BRRRR starts with a purchase. And if you don't know, let me tell you, a purchase money appraisal is not as conservative as a refi appraiser, because a purchase money appraisal has two willing parties. A refi appraiser has you and a bank. So I guarantee you a refi appraisal is going to be more conservative without question, probably to the tune of 10 to 15% more conservative. And the reason I want to bring this up is because there are lots of BRRRRs that blow up because you can't get your money out, or more importantly, you can't get your investors' money out. So be very, very careful with BRRRR. It may not be a problem if the market takes off again, but realize a purchase money appraiser or LTV on an appraisal, on a refi appraisal, is going to be conservative. Would you agree?
Oh, for sure. And I see thousands of appraisals every year. One thing I'll add to that too is a really common question for investors. I talk to tons of people doing BRRRR. Anybody who doesn't know, buy, rehab, refinance,
Rent,
or rent and refinance, repeat, all that stuff. Something that folks don't understand is if you're coming to get conventional financing after you've purchased, and for this example, let's say you buy with hard money, you invest some money into it, and you're coming to refinance. Keep in mind that if you do that within a 6-month time frame, as a lender, no matter what the thing is worth after you rehab it, I can't lend you more than 100% of what you bought it for. And I'll give you an example. You buy it for 200, you invest 70K in rehab, it's worth 400, and you're saying, okay, I'm ready for 75% cash out refinance. I want to pull out 300, all my investment back. Mm-hmm. If you try to do that after 4 months, the lender is going to say the guidelines say that our max loan amount is the 200K you purchased it for. And for whatever reason, there's so much information online that says, oh, you can bake in some rehab costs into the final settlement statement, or you could do this, magic wizardry. Very unlikely that happens. The more likely scenario is, one, you wait 6 months and then the lender says, okay, we can take the new appraised value. But like Mike said, a refinance appraisal is going to be conservative. Right now, Mike, I can't tell you the number of people I talk to. My neighbor sold for 580. This house that's not as nice as mine is worth 560. Their refinance appraisal came in at 540 because the refinance is, one, taking comps over the last 6 months. And we all know that today is not the same as September of 2020 was.
Mm-hmm.
And two, when you list for 549, you've got 20 people bidding to get your property. It's going to sell for 585. They either have an appraiser that's a little bit more aggressive on the purchase, or they just make up the difference. Whatever the case,
Mm-hmm.
the refinance appraisal versus the purchase appraisal, you're 100% correct that it's going to be more conservative. And so think about that with your BRRRR. You know, most investors just, they're very optimistic. And so it's like, I bought this 3 months ago, I put 30,000 into it. Now it's worth double. And I'm thinking to myself, well, we'll see what the appraise is at.
Yeah. So let's just go there. Let's talk about appraisals, why they're there, who they protect, what happens. Because again, and something else folks you need to realize is the appraisals of 2021 are not the appraisals of 2008. There was a lot of rules and regulations adopted after the housing crash because frankly, there was some funny business going on in 07, 08, kickbacks and all of those things. So let's talk about appraisals. Why are appraisers and appraisals an important part of the mortgage market?
Well, I mean, first and foremost, the banks are requiring them, and a lot of folks too. They're doing a 5% down, first time home buyer loan or something. Is just like, they're not realizing the bank's putting up 95%. You're putting up 5. They want to be really sure that this asset that's backing their investment is worth what everybody's saying it's worth. And so, I shouldn't say every single, there's scenarios where you get an appraisal waiver if there's 20% down or so. But, for most people who are buying, putting 3, 5, 10% down, you're going to need an appraisal. The appraiser is going to come out and it's going to look at, neighborhood comps and make a few adjustments, but it's going to give the bank assurance that this thing is worth, and that's something that's commonly misunderstood. Is the buyer thinks that this is an appraisal for them, which I guess to a certain extent it is, right? They're buying a house. They want to know what somebody appraises it for, but it's really protecting the bank.
Yeah. When I look at an appraisal, I actually think it protects 3 people, or at least it can potentially protect 3 people. So the one you've already hit, right? The lender, right? The person who's ponying up 95 or 97 or 80 or 60 or whatever it is. Whoever's putting up the rest of the cash wants to know what that asset's worth, and they have their risk profile that says, hey, in this example, I will lend this money because I will get this rate back. That ties back to rate and term, right? That's one of the variables in rate and term. The lower the risk, the lower the rate. The higher the risk, the higher the rate. Is that fair?
Yep.
Number 2, I do want you to realize as a buyer, appraisals can protect you from a mistake. It can. It doesn't happen a lot in a hot market, but I have seen markets, because I've been investing for 20 years. So I remember 09 to like 11 or 12, where the market was like this, not like this. And when you left the appraisal condition in there, there were plenty of times where the appraisal came in light or lower. And because it's in the contract, you can go back. And oh, by the way, I went back to the banks 20 times maybe and got lower prices because, again, it was part of the purchase. I had to agree. In this case, the bank was the seller, so they didn't care, right? They just said, fine, whatever the appraisal was, go. So again, appraisals, assuming you leave it in the contract, can protect the buyer from overpaying. Is that fair?
Yeah, for sure. Who was the third person you were thinking about?
The third one is Wall Street or whoever is doing it. Because what happens for most banks is, yes, they're the lender, but realize they sell it quickly, right? Maybe once a quarter, they create a package. And Wall Street buys loans at discounts, right? A bank says a loan for 30 years, but a bank will sell 10 or 50 or 100 or 10 million or whatever it is to Wall Street. They will take some kind of discount. And again, the discount will vary based on the criteria of all the loans. They will get a bigger discount if all the loans are 97%. They will get a lower discount if they're 70%. So again, Wall Street will be looking at the appraisals, at least at some level, to create their bonds or their whatever they're calling them today. So again, the appraisals are in there to create an independent third-party view of the asset, and then that review is used potentially by 3 people, in my opinion. Is that fair?
Yeah, for sure. And I like what you said about protecting the buyer, and some buyers, that being kind of a red flag or an indicator. You probably shouldn't pay this amount. Yep. It's happens with investors quite a bit when they go to get hard money, and the hard money lender says your ARV is a dream. You know,
Exactly.
there's no way this thing's going to sell for 450. So here's our numbers. And it's probably saved thousands of investors, millions of dollars, having a hard money lender say, no, this thing doesn't make sense. And so that's one of the backstops on the front end for an investor. When the person lending the money doesn't want to lend it to you, it's probably too risky.
I think that is very well said. So next up, I want to talk about a term that's thrown on a lot about. It's definitely, at least in my experience, one of the key variables in a mortgage loan, and that is debt to income.
Sure. Yeah. Debt to income ratio simplified means what you make versus what your debts are. And debts include what you currently owe and have monthly payments on, plus the mortgage. And so just to keep it super simple, let's say that a lender is going to allow you to have a debt to income ratio of up to 50%. And I'll talk about the two different debt to income ratios, because there's a front end and there's a back end. And the back end includes all your debts. So you've got student loans, a car payment, some credit card payments, and your new mortgage. All of these things combined, if they total $4,700 and you make $10,000 a month, then you've got a 47% debt to income ratio, and it works.
I just want to make sure one thing as we go forward, that 10,000 you just talked about, is that gross or net?
Gross. Well, here's the clarifying. Gross if you're a W-2 employee.
Right. W-2.
And I had this conversation yesterday. I love self-employed borrowers. I'm an S corp. I'm self-employed. I love entrepreneurship. Getting a loan as a self-employed borrower is harder, and the rules aren't fair. And I'm sorry, I don't make the rules. I just have to follow them. And so it's weird. I talked to somebody yesterday that, both husband and wife work for the state. And he's like, sure, I make $8,200 a month, but after CalPERS and all this stuff I'm paying into, I don't nearly take home that as much as that. I say, I agree. And I know, but $8,200 is what the lenders are going to use. Mm-hmm. Conversely, you're self-employed and your store has $570,000 in gross income, but you write off your, expenses and whatnot. And your bottom line is $82,000. That's what we have to use for your yearly income. So, quick clarification on that. But once we have that number for what you make, lenders are going to look at the back end ratio I just talked about, which is a collection of all the bills plus the mortgage. And they're also going to look at your front end ratio, which is just the mortgage payment. So of those $4,700 a month in payments, if 3,200 of it, or 32% of your income is the mortgage, that's your front end. So in the system that we're going to plug in and have it spit out, approve eligible, tell us whether or not the loan's going to go, it's going to say 32 front end, 47 back. And depending on other factors like credit score and loan to value, it's going to tell us whether or not the thing approves. And I'll tell you that mortgage guidelines have got a little bit stricter in 2020. I've seen some lenders actually go back though, Mike, where they tightened up to 43 or 45. Now they're back to 50. Some of the lenders that were squeezing the FHA and VA, the government loans, back to 50 or are back to 57 or 55, wherever the automated system will approve it. But know that I think as a general rule, you probably don't want a mortgage. And so even if the system might approve a 38, a 39 front end and a 48, 50 back end, I always like to throw that out the window and just talk to people about what is comfortable. Because if you talk to somebody and you make 10,000 gross at the state, you only take home 7,300 of that. Mm-hmm. If you've got a $3,900 mortgage payment, that's going to be.
Yeah. One of the things I remember, and again, I wrote about this in my book. One of my mistakes in the book is I did the first cash out refi, which again will be a term we talk about momentarily. And I just took the maximum because I didn't know. The bank said, how much do you want? I said, how much can I get? They said this number. I said, great. Lo and behold, I created my first alligator property. It was uncomfortable. I regretted paying that mortgage every month because I was stupid. Yeah.
Never buy alligators. I read the book.
Never. There you go. Never buy or create alligators. Exactly. So why don't we talk about rate and term refi? Because that may be a term It's actually something I'm doing today on a couple of commercial properties. Actually, I'm doing a rate and term refi. So let's tell people what that is.
Cool. Yeah. And that term, a lot of folks get confused because when you say cash out refinance, it's self-explanatory. Cash out refinance equals you get cash out.
Mm-hmm.
Rate and term refi basically means you're not getting cash out.
Mm-hmm.
And what the rate and term is you're changing the rate and you're changing the term.
Yep.
So you're making an adjustment there, but you're not pulling any cash out. You're just paying off your existing debt. And so, for simple terms, I think people can just think about rate and term is no cash out. Cash out refinance is taking cash out.
Yeah. So let's just give you the real examples. I always share what I'm doing. So for example, I bought a couple apartment buildings. Let's say it was 2010. I think it might've been 11, but let's say 2010. I think the interest rates we had on them were 6%. Maybe it was 6.25. So what has happened? Well, I've had 11. So first off, the term was 25 years, right? Commercial is different than residential. So it was 25. It had prepayment penalties, which I guess will be the next term we talk about. I think it was 5, 4, 3, 2, 1. And then, so I got to this year, I'm doing a rate and term, which the rate's going from, let's call it 6 to 4. But here's the magic, the term, because again, I've done 11 years of pay down, right? So I had 14 years left. I'm taking the term back up to 25. So what does that do for me? I get a double whammy, which means I get to save on my mortgage payment. I've expanded the term from what is only 14 years left back to 25. And I've taken an interest rate of 6 to 4. So as you might suspect, my monthly payment's going to go from 4 to 2 or something like that ratio, which again, for me, just adds positive cash flow, which is the business I'm in of doing. So again, rate and term makes a lot of sense, when it's going down. And in theory, even if rates went up a little bit, if the term was being stretched out long enough, you could, in theory, even have a lower payment in that example.
Right.
Very cool. Well, let's talk about prepayment penalty, because I just talked about it. 5, 4, 3, 2, 1. Let's use a loan of 200 grand. What does it mean when I had a 5, 4, 3, 2, 1 prepayment penalty?
Yeah, I mean that sounds like a commercial thing more than you'd see it in residential. But is that the points being paid in each year? 5, 4,
No.
3, 2, 1.
So what it is if I refied in the first year, I owed 5 points. If I refied in the second year, refied or sold, let's be clear, refi or sold, I owed. So let's just do the real example, because I just went through this with my bank. So if I had a 200K loan and I wanted to sell it or refi, or I died or whatever, right? We had to sell it. I would owe the bank 10 grand, 5 points times 200. If I sold it in the second year, I'd owe 8 grand. In the third year, 6 grand. In the fourth year, whatever it is. It just scaled down, right? Because commercial lenders want, I don't know why they do that, but they got the money, they make up the rules. So it's very common to have a 5, 4, 3, 2, 1, a 3, 2, 1.
Are the new loans being written today still having those prepayment penalties?
I have a 3, 2, 1 on the new loan.
Okay. And this is an important distinction for some people. If you're 5 units and up doing commercial, there's one set of rules. If you're 1 to 4, in my world of residential, prepayment penalties are very rare, especially in the conventional conforming space. Super common 2005 through 2009. And, I got into a loan where it was a 228 with a 3-year prepay. And so, my loan was going to adjust after 2 years, and I couldn't do anything about it because if I paid off my loan within 3 years, I would get in trouble. And so this is a common question I get, which I get to gladly explain. No, there's no prepay, and hardly any conventional conforming loans are ever going to have a prepayment penalty. So you can pay extra payments every month. You can pay off the loan in full. You can sell your house in a year and a half. Any of that, there's not going to be any penalty. The one place I still see it is the non-QM space, which is just alternative type financing, where if you come to me and say, I don't make any money on paper, but I've got a property that cash flows and I've got great credit and I want to put 30% down, a debt service coverage ratio loan like I'm talking about, that might have a 6% interest rate with a 2-year prepay. Well, it might be like a 2-1 in your case, where it's like, pay it off in the first year, you pay 2 points, you pay it off in the second year, you pay a point. Then after 2 years, you have no more prepay.
There you go. Yeah. Again, these are something that will happen a lot in commercial. Actually, I don't think I've ever done a commercial loan without some type of prepay. I want to make sure that's true. I think that's true. I can't remember one not having a prepay. Again, usually I'm doing loans that are fixed for 5 or 10 years. So the prepay is only the first part of that. So it's not an issue for me because I buy stuff to keep forever. So it's okay. But you're right. Back in 2008 and 9, a lot of my loans had some kind of prepay because again, that was how banks were making money, right? That was the story, right? Things go up forever, refi in 2 years. And they were just, it's crazy. So
I'm curious because just one quick question on that while we're on it, because I'm curious because I'm not in the commercial space a lot. But so that 25-year term, does it only have a certain amount of fixed in there? Is it 5 or 10 years fixed, and then it adjusts?
Yes. Yeah. Again, you can get fully fixed, 25 or 30-year loans, but that's typically much bigger. The longest term I've gotten fixed is 10 years.
Okay.
It's fixed for the first 10. Yeah.
Then it's tied to some sort of LIBOR
or something. Yeah, exactly. So let's talk about an escrow account. A lot of people wonder, what is it? Why do you do it? Should you do it? What's it do on it? Why does it show up on my mortgage statement? I don't know what's going on. Who's got my money?
Yeah, this is a popular video on my channel. What is an escrow account? And I made the video because it was such a popular question I got from clients that I kept trying to get better at explaining it, because I would explain it to somebody and then I would have I don't get it. And then I explain it a second time and I don't get it. Because what happens is an escrow account by definition is the lender, the bank, whoever's servicing the mortgage for you is holding money in what is essentially a savings account, and they're going to pay your taxes and insurance. Every 6 months, property taxes are due. Once a year, your hazard insurance is due. And so the bank is holding it and making those payments. Every month, you're putting a little chunk so that when the next payment is due, they have enough to pay it. And the confusion, Mike, comes when somebody looks at a settlement statement and they go, I'm paying a 6-month property tax bill. I'm paying my first year of homeowner's insurance. And you also want me to pay 3 or 4 months of homeowner's insurance and 3 months of property taxes? Am I double paying? What's going on here? And so I've tried to explain to people that, you're going to close a loan in March, and April is when the county wants their 6-month installment due. So you're paying that 6-month installment through the close of your loan. You're closing in March. You're not making a mortgage payment until May. And so the next installment that's due 6 months from now, we've only got May, June, July. There might only be 5 months of collecting 1/12 of what that annual tax bill is. And so the mortgage company, or the servicer, has got calculations. They're not going to hold too much of your money. They can't. By law, they can't have too much in there, but they also have to have a little bit of reserves for inevitable fluctuations. And so there's going to be a little extra in there. The good news is that they're super transparent about it. Every single month you get a mortgage statement, $17.84.59 is in your escrow account. You put $350 towards it next month, and the month after, and the month after. Then when your mortgage, homeowner's insurance is due, or your taxes are due, it clearly tells you, we sent a disbursement for $3,300 here, and we took that out of your escrow account.
Yeah. Again, escrow accounts, in my opinion, are built again to protect the lender, right? There are two things that will happen on every loan. They will require insurance, right? They want insurance on the asset just in case it burns down or floods or whatever. And they want the property taxes paid, because the only thing that can jump the line is if property taxes aren't paid and the state takes it back. So again, the lender is trying to protect itself. I don't know if it's common now, but I remember, I think it was on our primary home. If we agreed to get escrow an account, we saved an 1/8 on our interest rate. I don't know if that's common today, but I had that happen.
It just recently changed where if somebody wanted to waive escrows and say, listen, I'm going to take care of my tax and insurance, I don't want the lender to do it, I'm going to do it. There used to be a hit at a lot of lenders, meaning a slightly higher price. In the last 18 to 24 months, most lenders have said, listen, as long as you fit the criteria, which for conventional loans at a lot of lenders is you got to be under 90% loan to value. But as long as you're not, a 5% down, 3.5% down, you want to waive escrows, go ahead on, take care of that yourself. I'd add on too that besides protecting the lender, I talk to a lot of people. I talk to a lot of people about finances. Most people aren't the best at budgeting. For most people, it's a good idea. You know,
Yeah.
you don't want to have a $3,300 tax bill come up and you not be prepared for it. So I think it's really in a lot of people's best interest. There's the people that I talk to the most that say, I don't want to escrow. The reasoning is, as somebody who's self-employed, my income fluctuates. And when I get a big commission check, I want to pay my property taxes and I want to have that done, something like that. But for the most part, I think it's the set it and forget it, budget every single month, exactly what they need to pay tax and insurance can be a good thing.
Yeah, I'll just be upfront. I think 70% of our loans have an escrow account, and the ones that don't were set up at a time, because again, we've had loans for decades now where it just wasn't common, or maybe we weren't thinking about it. I generally think escrow is a good thing, because again, for me, it's time. I'll be honest. I don't want to be reminded to pay my my taxes and insurance.
Yeah.
If somebody else wants that headache, go right ahead.
Yeah, do all that accounting work for me and don't charge me anything for it, because there's no charge. They're doing that for you. There's no charge. And a lot of the pushback is like, that's my money. I'm going to put it somewhere. I'm going to gain interest. Set it in your bank account and collect 34 cents a year.
Yeah.
And have that extra 30 to 45 minutes of work per year. If you're good with working for 19 cents an hour, more power to you.
Yeah. So 2 more terms I want to hit before we kind of wrap up this video today. Let's talk about mortgage insurance.
Sure. Mortgage insurance is a common one. And there's misconceptions out there. I'll try to hit on some of those. Whenever you're putting less than 20% down on a home loan, mortgage insurance is going to be required. And I already hear people in the background, it's not always required. There's some loans that have less than 20% down where mortgage insurance isn't required. Well, it's baked in. It's lender paid mortgage insurance if you're not paying it. So it's required.
Somebody's paying it.
Somebody's paying it. It's getting paid somewhere. And so you do an FHA loan with 3.5% down. You do a conventional loan with 5% down. In order to protect the bank against what is extra risk, because there's less skin in the game, they're going to charge you mortgage insurance. And it's easy to know what mortgage insurance is on an FHA loan, because you can take that 0.85% calculation and just say $400,000 loan, 0.85%, divide that by 12. And I don't have a calculator in front of me, but that's what your monthly mortgage insurance payment is. For conventional loans, it's different, and it's based on loan to value, and it's based on credit score. So part of the conversation and assessment when you're talking to somebody, and I'm going to put down 3 or 5% on a home loan, I don't know whether I should do FHA or conventional, is, how much are you putting down? What's your credit score? Because if you've got an 800 credit score and you're putting 5% down, your mortgage insurance is going to be super. That factor, instead of 0.85, might be 0.23. And I'm guessing at numbers. I'm not giving exact examples, but conventional mortgage.
So mortgage insurance also scales based on the riskiness of the borrower.
Correct.
Wow, I didn't know that.
The caveat though is not for FHA. FHA just says this is our flat mortgage insurance fee.
Got it. So okay, that's what you mean by conventional lender. So
Right.
Wells Fargo versus FHA.
And
so I did the math just so we can put the video in there, right? FHA loan, 400 grand, 0.85% of that will ultimately equal $283.33 a month. That's the cost of the insurance premium.
And here's the not funny thing, but here's the thing to think about is, if you come to me and you've got a 655 credit score, or you've got a 725, that's the same 283.
Okay.
But if you've got a 655 and I run it conventional, you might pay 350 on a conventional loan. Whereas if you've got a 780 credit score, you might pay $72 a month.
Interesting.
And it makes sense that a lot higher credit score, the bank sees you as less risk, they're going to charge you less mortgage insurance. Conventional mortgage insurance has come down so much in the last couple of years that I try to at least have the conversation with people that are really anti-mortgage insurance. Well, I listened to Dave Ramsey or my Aunt Sue. Somebody told me I should never pay mortgage insurance. You can do 5% down on these size loans, Mike, and have it'd be 1/4 of that, like a 0.22 or 0.23 factor. And, if you put 10% down, it's even lower. So maybe at 10%, it's only $52 a month.
So let me run this by you, because again, this is this. I mean, I know what it is. Obviously, I didn't know it's scaled. I didn't know there was variation between FHA and conventional. I'm learning stuff. That's why I love this channel. So what I think I heard you say is, folks like you in the broker's position, if you're putting 5% down or something less than 20%, most of your business, if it's a lower credit borrower, will go to FHA because it's fixed. And then what you're saying is the better qualified buyer at some credit level will go banks. So is it fair to say that FHA is just this collection of, I guess, riskier loans? I don't know what else to say.
Yeah. I mean, FHA is, when I talk to people about what FHA lending is, they're less strict on credit requirements. They're less strict on debt to income ratios as well. So those debt to income ratios are going to go, and maybe that's part of the reason why these loans have a function of that mortgage insurance does not go away on FHA loans. It used to fall off at a certain point. As of a few years ago, they just said it's on there for the life of the loan. And so the ones that make it out, get refinanced into a conventional loan where it will either be taken off with the refinance or it'll fall off naturally when you get to 80% loan to value. But yeah, I mean, I guess the FHA product is meant for borrowers who just, they got a little hair on the file.
Little ding or whatever. Cool. Okay. All right. So our last kind of vocabulary or discussion point is going to be PITI. What is
that? It's principal, interest, taxes, insurance. I don't know why I blanked there.
Let me help you.
more coffee, coffee.
There you go.
But yeah, you'll hear somebody, and it's funny because on my end, some people will throw terms back at me. So they'll want a scenario to be run, and what's my PITI? And that's basically your whole payment. Yeah. So when you pay,
that's the number you write the check for.
Right. So you're paying your mortgage company, the principal, interest, taxes, and insurance. And that's the payment that when you're looking to buy a house, you definitely want to look at that payment. You don't want to look at, you pop on a Zillow and you use a calculator and it says, you buy this house and the payment's $1,283. If it doesn't include tax and insurance, it's not what you're paying monthly. So it's not a really good indicator of that. So yeah, that one too. You can include mortgage insurance in that as well, because
it's the full payment.
Sometimes there's two eyes in there because there's hazard insurance and there's mortgage insurance. But yeah, it's basically your whole payment, and you'll see that thrown around here and there. So if you see PITI, know that it stands for principal, interest, taxes, insurance.
Very cool, man. So one thing I want to ask you, we didn't prepare this, but again, you and I look at the mortgage market all the time. I think the 10-year notes actually come down from a week or so ago. So I'm curious if interest rates have rolled over slightly in the last 48 hours.
They have slightly, and it's been a slow tick since that January 6th date, where I think Wednesday through Friday, 6, 7, 8, and then the following Monday, Tuesday, I had 5 straight days of red. And
red meaning they went up.
Rates up. And I think the stuff I priced yesterday was right about at January 5th levels. So I think we got it all back.
Yeah, it's really close. Yeah, that's what I was seeing as well. So, hey, buddy, thank you very much again. Please, if somebody's in California or somebody wants to talk mortgages, how should they reach out to you?
Matt, M-A-T-T, at mattthemortgageguy.com. Send that email. Somebody on the team will make sure it gets to me. We'll answer your question the best we can. If we can help and assist with a purchase or refi, we're happy to. If it's just a random question, happy to help with that as well. And if you want really straightforward, good mortgage advice, Matt the Mortgage Guy on YouTube, go subscribe to that channel.
Very cool, man. And again, you can do business in California, but you're happy to talk anywhere.
Right. And, I used to pick up phone calls from every area code. Then I realized, 10, 15-minute conversations times 50 per week for the guy in Tennessee who wants to talk about his debt to income ratio. I love everybody. I love to help everybody, but I really can't. So send an email if you're out of state and just explain your scenario. Because a lot of times I can reply in a minute and just say, you know what? It looks good. In your scenario, based on what you told me, things are good. You're getting a good deal. This is totally common. And I think that's what people want more often than not is like, hey, my lender told me this, but they're the one getting paid on the deal. Are they shooting straight with me? And sometimes it's, they're shooting straight with you. And sometimes it's like, I'd probably talk to a second person.
There you go. Well, thanks, buddy. I appreciate your time. Have a wonderful
Yep.
day.
Thanks, Mike.
Mhm.